Zach's Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. Now we're going to look at a neutral to bullish strategy called a calendar call spread. What is that? Well, Kevin Matras, our options guru here, will fill us in on just what that is. I've heard of these before, but I have to say that I'm not sure what they are.
Yeah, you're not alone. What's interesting about this strategy is that I think for a lot of people, even if they aren't that versed in options, I think a lot of people have probably heard of the term calendar spread.
Do you need a calendar?
No, you do not need one.
Oh, okay.
Whether they knew what a calendar spread was in the first place, though, is another story. But that's what we're going to be talking about today. So.
All right, so lead the way.
All right, I got a couple of slides here, so let's check them out. A calendar spread, which is also known as a time spread or horizontal spread, is when you sell or write an option in 1 month and buy an option with the same strike price but in a different month that is further out, okay? Since the option you're writing has less time, which means it's going to be worth less, and the one you're buying has more time, that's going to be worth more. This can also be referred to as a debit spread as well. Now, you can do this with puts as well. You can sell a put in a nearby month, and you can buy the same strike in a further out month. But as you would expect, if you did the call calendar spread, you would have a slightly bullish bias, neutral to bullish bias. If you did it with puts, you would have a neutral to bearish bias. Now, also, too, you can sell a calendar spread, and what that means is you would be buying the nearby month and you would sell the further out. In that instance, you would actually be putting this on as a credit, but for today's conversation, we're going to be focused on the long side, which is the debit spread.
All right, so give us an example so we can crystallize in our minds how this works.
Okay, so let's use IBM as an example, okay? Let's say you wrote the February 185 call for $340. That means you're collecting $340. And let's also say that you bought the April 185 call for $640, which means you've paid $640. So the net cost or debit would be $300. So the main question is, why would I do this? The reason why you would do it, first off, is that you have a very small and limited risk, so your risk would be limited to what you paid for the spread, and in this case, you're talking about $300. The maximum profit would be determined between the difference in the strike prices at the expiration of the nearby month. So let's continue on with this example.
All right.
Let's say at expiration, IBM closed below 185, okay? At expiration, the February 185 call I wrote for $340 is now worth 0, which means I made $340. The April 185 call that I bought for $640 might now be worth $500, which means I lost $140 on the one that I bought. But now my calendar spread as a whole is worth $500. So $500 less my cost of $300 means I have a profit of $200, which is equivalent to a 66% return. Now, if I wanted to, I could decide to hold on to the call that I purchased because I still have several more months. If I thought the stock was going to go higher, I could hold on to my call and I could make even more money. But it is important to know that if, let's just say, the stock started to go back down, you could give up the rest of that premium, but in its whole, you still are limited to that original $300 outlay. So you still have this limited risk, okay?
Okay. Well, overall, it sounds like a straightforward strategy anyway.
It really is. It is a great strategy, and granted, you are limited in your profit potential, but you are capitalizing on the dynamics of time decay, okay? Some people probably don't really consider this because they would believe that the profit potential is too small, right? $200. But if you think about it in percentage terms, 30%, 40%, in this case 66%, I mean, that is no small thing. So if you were to put on, let's just say, 10 of these things at once, your outlay is $3,000, but if you made $200 on 10 of these, that's a $2,000 return, and that is pretty exciting.
And even if they are small, no one ever went broke taking a profit.
Right, very true, very true.
Do you have this strategy on right now?
No, but I am going to be putting this one on, and actually the reason why I am using IBM is because these are the prices that I had seen as of yesterday. I think this is an excellent strategy.
Okay, yesterday being January the 11th.
Yes.
Of 2012, in case you're following it on your calendar. You can find a text version of this piece in the options section of our homepage. You can link to it from there anyway, Zax.com, if you're not there already watching this video, and all of the information regarding this particular strategy and other options information is all there to help you know your options. With Kevin Matras, I'm Terry Ruffalo.